Okay. Well, hopefully everybody out there can hear me and see our screen here. And we thank everyone for joining us today on our webinar on the do's and don'ts of driver per diem. If you're having any issues here and you're seeing, please just let us know in the chat box. We can view that and see what's going on there, and we'll do our best to remedy the issue. Many of you we already know and are familiar with HCH, and we thank you for joining us today. And for those of you who aren't familiar with HCH and what we do, just as a quick overview, we are consultants in the trucking industry, and one of our main areas of focus is indeed driver per diem, what we're going to be talking about here today. We've rolled out numerous per diem programs for fleets all over the country, including some of the largest in the country, to basically help find ways to maximize driver savings, driver retention, recruiting, and do all that while properly running a compliant per diem program. Over the last year, there's been a lot of misconceptions about per diem, driver per diem, and we've heard a lot of it with the new tax code. And so that's why we wanted to put this webinar together and discuss some of those questions that we've heard in regards to driver per diem for those of you who may be considering setting up a new per diem program and what that might mean for you, as well as for those of you who currently have a per diem program, and basically discuss what it means to have a successful compliant per diem program. My name is Dave Hatch, and I'm joined here today by Tommy Dean. Tommy Dean is our in-house counsel here at HCH. Tommy is a per diem expert. He knows it in and out. He's read the per diem codes and been involved with numerous per diem audits, successful audits with the IRS, and knows it like the back of his hand, probably better than anyone I know in the country. So with that, I'm going to turn the time over to Tommy to lead you through a discussion on per diem, and we'll go from there.
Thanks, Dave. Just one quick housekeeping issue. If you have questions, you can go ahead and submit those in the chat box. That chat box only goes to Dave and I. We will try to get to those questions at the end of the presentation. With that said, obviously, we would be in dangerous company if we didn't give some sort of legal disclaimer. I don't think anyone on the presentation today expected us to give legal advice or tax advice. We couldn't possibly know the ins and outs of every single situation you have out there as a carrier. So in regards to the questions and in regards to the presentation today, if the questions are of such a nature that they're specific, we obviously can't answer those during the presentation with everyone on. And we do answer specific questions about per diem plans. We do analyze and assess per diem plans that carriers already have in place. That is one of the functions that we perform, but and clearly we couldn't do that here today. What you will get are 7 really good tips about areas to be on the lookout for, sort of the main emphasis of what we look for and what we look to solve in the per diem world when we go in and administer a plan. There are going to be 7 of the most key areas you need to pay attention to. And what you will get are starting off points, whether internally or with an advisor, to say, okay, are we doing this? Are we doing that? So for the people on the call that might not know what per diem is, maybe you joined us and this is your first ever real experience with per diem. It's really simple. It's a way to offer tax-free reimbursement for meal expenses while traveling away from home on a business. We all understand that our drivers are out there. They're on the road because we put them there. They're buying $12 sandwiches. They're buying extremely expensive coffee. And they wouldn't be doing that if they weren't out there for us. This is just a way to provide them tax-free compensation for that. Some of the questions that we get from carriers or drivers sometimes is, well, does it include this or that or this or that? Things that, for instance, that it does not include: personal expenses, hotel expenses, gloves, tire thumpers, uniforms, things of that nature. This is strictly for meals. That's what it's designed to do. So if it's not a meal, then the answer is no, that's not what we're talking about here today. So some of you may be asking, well, why would we even be talking about per diem today? There are two, sort of thought processes that we think about here. One is per diem is just generally a relevant topic because of the driver savings. It was relevant before 2018 and 2019. It will continue to be relevant as long as the code exists to support a per diem plan. And those driver savings largely come because a driver doesn't pay FICA, federal income tax, or state income tax on any of the per diem we pay to them. So driver savings make it generally always a relevant topic. More recently, as Dave, had perhaps mentioned, we've had a lot of tax code changes in the last year, and that's made it even more relevant. The biggest of those tax change code is that in 2018, the code suspended all the miscellaneous deductions. When it did that, it also suspended the ability of a driver to take per diem on his own. So a driver can no longer do that. If a driver wants to receive tax-free reimbursement or tax-free compensation for those meals, he will have to do so through a company per diem program. And that really has put per diem at the forefront of driver recruiting and retention. That has been the genesis of a lot of the plans that we have implemented this year alone. And so that's really been kind of an interesting change over the last year. Another interesting change that we've seen is the lower corporate tax rate. Per diem is only 80% deductible. So you have to pay tax on 20% of every dollar that you spend. Well, obviously, if the corporate tax rate has been lowered, that makes it more beneficial for a company to offer a program, or at least less detracting. And then, of course, we have that same deductibility has evolved over the years. And back in the 90s, it was set at 50%, and then it sort of stair-stepped up 5% at a time every 2 years till it reached a maximum of 80%. And so, this just emphasizes the continuing monitorization that we have to do. We have to continually monitor the tax code for that deductibility, among other things. And then, of course, we have IRS regulation changes and stuff throughout the years. And so we monitor all those. We had one just in October where we raised the rate from $63 to $66 a day. And so per diem is going to continue to be a relevant conversation even after this year. Overall, we're always concerned when we administer a program, when we implement a program, about three main areas. The first area is obviously the impact to the driver, and we've already discussed that a little bit in the previous slide. The second real consideration that we're going to always be having is what's the impact to the carrier. Full disclosure, any time we implement or administer a per diem program, we fully anticipate that the company will save something. The company will benefit somehow on the bottom line savings for implementing the plan. It's not just a driver-centric plan. There is a give and take here. There is a balance. And finally, of course, what we're going to talk about mainly today is the IRS compliance portion of that. It's not enough that we can just offer our drivers tax-free money. We have to be certain that when we get into an audit, we're not gonna cause a bigger problem for the company. So, tip number one in that regard is probably the most dangerous area that carriers need to avoid, and that's avoiding wage recharacterization. Simply put, wage recharacterization is paying the driver the same amount of money, whether or not the driver is out, whether or not that driver has meal expenses while on the road. For our industry, the most relevant and recent ruling is 2012-25. And what 2012-25 essentially says is it boils down the tax statute and says if you are paying a driver the same whether or not he is out as if you would otherwise, and you're paying that driver a per diem, you're guilty of wage recharacterization. And you do not have a business purpose for paying that driver that money. You failed a business purpose test, you failed an accountability test, and you end up paying 15% interest back, 15% back plus interest and penalties. That's the FICA tax. So you pay back every penny of FICA tax you should have withheld. probably the easiest way to explain what exactly wage recharacterization is using a hypothetical. So here we're going to assume that I'm a truck driver. And we're going to assume my base pay for ease is a salary $1,000 per week. And in this hypothetical, at the end of each week, my carrier is going to take and calculate the number of days I've been away from home. And they're going to multiply that times the new IRS maximum of $66 per day away. And so we'll assume and then they're going to pay me that instead of paying me the wage. We're going to assume, let's say that I was out one night a week. So instead of paying me $1,000, they're going to pay me in taxable wage. They're going to pay me $934 in taxable wage, and they're going to pay me $66 in untaxed per diem. In either situation, I'm going to receive the $1,000. I'm going to receive the same amount. That is classic wage recharacterization. These are what the rules are based upon. It's really clear under the case law. It's really clear under the statute. This is unacceptable. This will put you in a non-accountable plan. We see carriers make this same mistake over and over again, or slight variations of it. There are many other ways, little nuanced ways of committing wage recharacterization. So you should definitely give it some thought. You can go read 2012-25 for the exact specifics of, maybe some of the more nuanced ways that you can commit wage recharacterization. You want to avoid this at all costs, though. And our goal here for hypothetical number one is really simple. We want to avoid paying back all the FICA that we should have withheld, both for us and the driver. And that's a 15% penalty of every dollar that we paid out in per diem. So that's a pretty big risk out there. Tip number two, in sort of a similar vein, which will also help you avoid recharacterization, is creating like groups. It's pretty easy to see how this could lead to a recharacterization of wage. If you have a group and it has drivers in it, some of the drivers may get 5 nights out per week, but let's say you have a driver in there because the group's not properly set up that also has 0 nights a week, and you're paying that driver per diem. It's pretty easy to understand why the IRS would see that as wage recharacterization. You're paying the drivers the same amount regardless of whether or not those drivers have meal expenses while away from home. Obviously, that looks like an accountable plan to an auditor, and you would have a hard time surviving an audit. What we do in this regard is sort of a two-step process. It's pretty self-evident. First thing we're going to do is we're going to assess the current way that a carrier splits up their groups. Is it geographical? Are you splitting your groups up by workload? Is it done by driver manager? And then we're going to assess whether or not that is proper, and whether or not that would survive scrutiny by the IRS. It's not enough that you can just say, well, I put my regional drivers over here, and so they're in one bucket. Well, might your East Coast regional drivers look a little different in their workload from the West Coast drivers? Sure. They might be out entirely different days. They might have a totally different, they obviously have totally different routes. And so, you have to use a little bit of common sense and a whole lot of data. And then the second thing we're going to do is obviously we're going to reevaluate those groups, and we're going to try to group drivers into comparable rates and similar workload. What are the drivers actually doing, so that we can kind of make them look enough alike that we understand what they're going to do. The goal here for tip number two is really pretty straightforward. We're trying to avoid overpaying the driver. The IRS doesn't like it when you overpay drivers. They have a really low tolerance for overpaying the drivers, and one of the prime ways of being able to avoid doing that is by correctly grouping your drivers. Tip number three, this is we call it per diem eligibility. The gist of it is who should be on the plan and who shouldn't. This is the main question that an auditor would have. It's a lot of times the carrier can't properly answer it. It's like, well, how did you decide who was going to be on your per diem program? Well, everyone's on my per diem program. Why wouldn't I pay them per diem? Well, there's probably some really good reasons why you should look at this. Or Well, I don't know why we grouped them like this. These seem like regional drivers, and so that's why we put them down here. The reality is when we do this, we base this on two things: data, and usually a whole lot of data, and then operations. What are the drivers going to be doing? And honestly, it's not always self-evident why we may have ineligible drivers. Obviously, the number one possible ineligible driver is the guy that doesn't have any days away. He's just simply not at home. Maybe he's a local delivery driver and he gets home every single night. And so that driver, obviously, we shouldn't be paying him per diem. At the very least, we should get that driver out of there. In a similar fashion, though, you may have drivers that are sporadic, that, maybe they get 3 nights out this week and 0 the next and 0 the next, and we can't really afford, because of the IRS scrutiny, to put that driver on a program. And that's unfortunate, but, it's just a situation that we're in. These are the types of decisions that we're always making whenever we're trying to determine eligibility: who's going to be on the plan, who's not going to be on the plan. You don't want to leave this up to an arbitrary decision. The other two that are sort of strange for carriers to think about, and we've really had a lot of these types of drivers come into the industry over the last couple of years, are hourly and salary drivers. As an industry, under the IRS regulations, we're permitted to pay our drivers in two ways. The first is we can pay our drivers like any other company. We can pay them the $66 per day. And then if we do that, we have to play by all the rules that any normal company would play. We have to substantiate all the same things that those companies would have to substantiate. And that's perfectly acceptable. A lot of these same rules would apply. The second way that we can do that, we can pay a driver per diem, is we can pay a driver per diem however our industry paid drivers per diem on December the 31st, 1989. That's literally what the rule says. On December 31st, 1989, if our industry, the trucking industry, paid a driver per diem in such a manner, we can continue to pay them. On that date, our industry paid drivers per diem as a cents per mile. So those are the two ways that we can pay drivers per diem in our industry. You can easily see how, as a carrier, it might be difficult to pay an hourly and salary driver a cents per mile per diem, how to administer those plans. Not that you can't do that. We administer hourly plans. We administer salary per diem plans for those types of drivers. It is not impossible, but it's one of those things that you need to look at carefully before you try to implement a plan in that manner. The final, maybe the best tip I can give you for your eligibility is this is not a one and done thing. We've seen a lot of carriers over the years, one of the mistakes they make is they set their per diem program at the start, and maybe they do a really good job of rolling it out and getting it implemented and making all these different determinations, but then they just sort of let it run its course. The IRS is really clear that you have to continue to monitor your plans, and so that's one thing that we are constantly doing, because especially in our industry, there's a tendency to say, okay, I want obviously to take on new business, and that means I'm going to have to take on new routes. I'm going to have to take on new shippers. I may take on totally different lanes, and I may use some of the same drivers out of a group or out of my fleet to do that. Well, obviously that needs to be taken into consideration if we're going to run an accountable plan. And we see a lot of sometimes that doesn't happen. The goal here for tip number 3 is we're trying to demonstrate to an auditor that we have an accountable plan. That's always our goal here with eligibility. When that auditor asks, how do you determine who is not and who is going to be eligible for per diem, we want a good answer. And that's our goal for tip number 3. Tip number 4 of 7, we're going to set correct rates. Probably one of the second or third most obvious problems that we encounter in the per diem world when we're talking to carriers is they don't really have a good rational reason for why they set the rate to what they have. Carrier, we ask the question, why is your rate set at this? This is for per diem programs that are already in existence. Why is your rate set at this cents? Well, John down the street runs a trucking company, and that's what he set it at. Or, this big carrier set it at that, so I just set it the same rate as those. Well, might your lanes and workload be a little different? Sure. So you ultimately, much with all the rest of our tips here, you just don't want this to be arbitrary. And there are two main things you need to be worried about. First, we call setting out the amount. And this really comes from the Boyd brother case from 1995. Interestingly enough, one of the lead attorneys for Boyd Brothers was one of the former founders of HCH. So we know a large amount of background data for this case. But essentially, we need to set that amount out at the time of payment. That's an absolute requirement. The case law is, really clear on that. And that means we have to avoid retroactive rate adjustments. We get this question a lot from carriers. Well, I didn't really run a great program January through June, the first 6 months. Or maybe I didn't have a program at all for the first 6 months of my tax year, but I really want my drivers to experience the benefits of your plan. Can I unbreak the egg? And the answer is clearly no. You can't go back and delve into your payroll system and start adjusting withholding based upon a retroactive adjustment. That is clearly unacceptable. It's gotten a lot of carriers in trouble. Literally, the IRS has locked the gates of carriers who do that. And we get that question almost inevitably when we start talking with a carrier about rolling out a plan. The second thing you need to really be concerned with is you actually need some sort of rational basis for your rate. You need it's called reasonably calculating. That's what the regulations call it. And the absolute heart of reasonably calculating a rate is properly calculating the days away from home. And I would warn you that you need to really get into the IRS regulations for that calculation, because a day isn't always a day. There are unique specific rules that allow us to maybe count a day or maybe not count a day. And you need to take some care doing that. Sort of some 3 easy ground rules that should be pretty obvious is, you have to obey the IRS maximum. You can't pay them more than $66 per day in per diem. You can pay it, as we've already discovered, 2 different ways, either as daily or as a mileage rate. And then, of course, you don't want to be routinely making excessive payments. You want to take all these sort of things into consideration, because your goal for tip number 4 is you're maximizing the driver benefit without overpaying. We see a lot of carriers, especially ones who may pick a rate at random, they sometimes drastically underpay their drivers. The issue with setting a rate way too low from a driver's standpoint is that obviously eliminates a lot of the benefit they should be receiving but are not. So you don't want to sacrifice to the drivers. At the same time, you don't want to overpay your drivers. So it's this delicate balance, because, again, IRS doesn't like that. So that's sort of our goal for setting the correct rates. Tip number 5, don't necessarily just calculate your days away. You need to substantiate this. You need to keep these records such that they're ready to go for an audit. And of course, like everything else, this is going to require a careful calculation. The methodologies could change depending on the carrier and what the carrier has available. What data set are we going to use? I would caution you that when we do this, you want that data set to match whatever you're going to show the auditor on your continued reporting as you go. We're going to get to continued reporting, but I never want to be setting up my plan or adjusting my plan based upon a data set that then I don't have access to later on, or on, have divergent. I base my plan on this, but I do my reporting based upon this data set. That's probably going to cause you surprises, and we don't like surprises. That's one of the hallmarks of what we do. There are all sorts of different ways. The one thing I can tell you about this is it is unique almost to every single carrier. Every carrier has a different set of data available and a different mindset when it comes to keeping track of drivers and what they're doing. And so this is really one of those areas that you have to dive into what you have. And ultimately, probably the best advice I can give you is you need to keep your records. I don't know how many carriers we've been to, and a common, finding that we have is, do you have records? Well, I have records for the last 6 months or the last 90 days. But we're talking about a 3-year statute of limitation from the date of filing. So the reality is you need to keep at least 4 years worth of records, and those records need to be good enough to satisfy your auditor, because ultimately that's our goal for tip number 5. We substantiate the days away because we know an auditor is going to ask for them when we get into an audit. And get into a serious audit, that auditor is going to want to see that we are keeping track of what we're doing very well, and that we're careful in that sort of calculation. Tip number 6, your plan needs some sort of reporting mechanism. This comes straight out of Revenue Ruling 2006-56, and we need some way to track and report excess. And excess is simple. It's anytime we overpay a driver. We all understand, the IRS understands we're never going to be perfect. This is never going to be a perfect plan. There will be times when we overpay drivers, and we need an ability to drill down and see when we do that on a continuing basis. At HCH, our ability to handle this, how we normally tackle this problem is sort of, again, with the 2-step. The first thing we're going to do is we do a lot of back testing, and we're going to back test with the same type of data that we're going to be using going forward, just like with the previous slide. We don't want those data sets to be divergent. And we're going to do a lot of back testing because we want to know when we implement the plan that it's going to be successful. We want to know the best that we can that our reports are going to be predictable. And the only way we can really do that is by understanding what the IRS is going to be looking for, and then we sort of back test. We get in there and we start filling out the reports and know what's going to happen for the next year or two, as long as the rest of our assumptions remain the same. The goal here is really easy, as with many other things. It's to survive an audit. It's to make sure we operate an accountable plan. Because again, the stakes are really high. If we don't operate an accountable plan, we're going to end up paying 15% of every penny we paid in, and that is disastrous. So, here we're really worried about making sure that we can show an auditor, yes, we do reporting, we report the excess, we understand as an ongoing basis, as a continuing basis, this is exactly how much we've overpaid drivers, and here's how our plan is running. The final tip that we have is we just call it audits. And the one piece of advice I can really give you in an audit is only go into an audit with the help of a seasoned per diem experts. We not only consult in auditing, we actually conduct the audits for all of our plans. That's part of what we do. We've been through numerous audits, and they've always been no change when we're administering the plan. And part of that is we're involved from the very first discussion with the auditor to the final assessment, the final zero assessment. And we have seen case law made over and over and over again by carriers and by drivers who tried to go it alone or got an expert in too late in the process. And again, the risk is just way too large to will it go into this on your own. The risk is 15% of all the per diem paid plus the penalties and interest. It's a huge dollar amount. You want to be certain of the answers you're giving an auditor. You want to understand what that's going to mean to the final assessment. You want to understand what the weaknesses are of your plan and how to shore those up before you get into the nitty-gritty of that audit. So this is really maybe the best tip that we have, because the goal here is really easy. You want to survive the audit with your plan intact. We do not administer plans that pose a danger in an audit. We want to know when we get in the audit, not whether our plan is accountable. We want to conduct the audit. We want to say, this is what we are going to provide you. And because we know when we provide you those things, our plan will be deemed accountable and we'll get a zero change audit. It's never a case of, well, how bad is the assessment going to be? It's always, this is what we have. This is what we know, what the rules are. We know how we set things up. We know how we monitor to them. We're in the safe zone. And that's really where you want to be. Because again, the benefits to a company can be large, but the risk of doing this by yourself is much, much greater. So what we've given you in the kind of 7 tips in that area really involves administering a plan from an accountable standpoint. Is the plan accountable? Will it survive IRS scrutiny and audit? Sometimes a carrier wants to ask, well, what if I want absolutely zero scrutiny by the IRS? I want to know that my plan is 100% bulletproof because I've done X, Y, and Z. There is a safe harbor. For the non-tax people on the presentation, a safe harbor is really just an IRS term, tax term for if you do X, Y, and Z, you can expect great results. We will do A, B, and C as the IRS. You'll pass your audit. There will be no change. And this is really called the Diem substantiation safe harbor. So if you set your correct rates and you pay a mileage rate and you don't recharacterize wage and you properly use a mechanism to identify excess and you add that excess back into a driver's taxable wage on his next paycheck and you keep proper records and you don't have any other indications of abuse, you fit within this knee safe harbor. That is a really, really difficult safe harbor to fit into. We have administered plans and we have set up plans to satisfy that safe harbor. They work really extremely well. It is a possibility, but the vast majority of our plans do not fit neatly within that safe harbor. And so we rely on the knowledge and the experience of the audits and the auditors that we have. We rely on our knowledge of the case law and the regulations to use the other areas of the 7 tips that we gave you to really make sure we pass IRS scrutiny. But we wanted to let you know that this is out there, that it is a possibility. I'd like to summarize right quick before we get into something else, but I'd like to summarize the fact that go back to where we began. This is always an exercise in these 3 areas. If we can't save a driver anything, if we can't increase the driver take-home pay, then we just simply won't operate a per diem plan. That's what it's designed to do. Again, company savings. Our plans, the way we design our plans, they're always designed to provide some sort of economic benefit to the carrier. In addition, with the tax code changes, it's really sort of the driver retention and recruiting is really sort of driving the per diem changes and the per diem plans we've implemented over the year. And then finally, of course, you have to be able to do 1 and 2 while remaining IRS compliant, managing an accountable plan. And this is what we do for carriers. These are the balls that we juggle, the headaches that we take away for the carriers are we manage all 3 of these areas whenever it comes to implementing per diem plan. Those are that's the main takeaway that we have. I think now is a good time to turn it back over to Dave and for quick Q&A session.
Yep. Okay, Tommy, appreciate it. Thanks everyone who's been joining us, and we know it's a complicated area. There's always a lot of questions in regards to per diem that we encounter and continue to encounter, and we know that area well, and we help fleets both looking to implement a new program as well as fleets that currently have a program basically capitalize on that program to revamp it and make sure not only it's compliant, but that you're realizing the most benefit from it. If anyone has questions before we get to the Q&A, I want to let you know, you can feel free to contact us anytime. There's our phone number right there for HCH, and Tommy's email as well as mine. Feel free to reach out to us anytime. There's also the link to our HCH website. There you'll find some more information on per diem as well as some of our other services, including fuel tax recovery, licensing work, titling work, permitting, a gambit of some of the other things that we do there that you'll find information on. Before we leave you, like I said, we have a couple questions that we want to get into. Tommy, do you see the questions there?
Yeah, I see the first one. Do you see the first one, Dave?
Yeah, there's a first question we're going to get to is in regards to tip 1. The question was, can you go back to tip 1? If we calculate each driver's days away from home and then multiply that by 66 and subtract that amount from their taxable earnings, how is that wage recharacterization?
No, that's textbook wage recharacterization, because you would have paid the driver the same amount regardless of whether that driver is out or the driver is not out. Back to the $1,000. Let's say you were going to pay me $1,000. You were going to pay me $1,000 taxable wage, but because I was out, now you're going to change some of that money into non-taxable wage. That fails the business purpose rule, both under the statute and under the regulation by the IRS. And that's, that is the textbook definition of wage recharacterization. There's plenty of case law out there that specifically outlines that you're not allowed to do that. That really is the crux of that. You're going to pay me that money regardless. You just want to call it per diem now instead of wage.
Permanently reduced.
Yeah. So to do this legitimately, let's say you knew that I was going to be out one day every week, or you took a gamble, you averaged it out. You could say, okay, now I'm only going to pay you from this day forward $934 in wage, regardless of whether you're out. That's what I'm going to pay you. And then when you are out, I'm going to pay you an additional $66 per day. That's perfectly acceptable. We set up plans like that. So there are ways of doing a daily per diem pay, but you have to set out that amount. You have to know what the wage portion of that employee's pay is going to be, irregardless of whether they're out or not.
Okay. Hopefully that answers that for you. We have another question. Looks like on recharacterization as well. It says, I'm confused about your definition of reclassification. Our provider tells us the number of days our driver qualifies for per diem. So a driver gets $1,000 pay, then we pay the per diem $66 times the numbers a day, and reclass the per diem so that the employee is getting a tax benefit. Are you saying this is reclassifying? If so, how should we do it?
Yeah, so I think that's a really specific question. That goes back to the example I just said. As long as you're not changing the wage amount and you're adding the per diem on to that, you're paying them more when they're out, not the same amount. That's not wage recharacterization.
Yeah, and feel free to send that information to Tommy as well, and we can look closer at specific examples. Obviously, as we mentioned at the beginning, there's very specific things that are unique to each situation, and we can kind of review those as well. The next question, Tommy says, you mentioned continue reporting, and then an accountable plan needs to pay excess back to drivers. What reporting does the IRS require beyond 940 and 941s?
So continue reporting is, it's unique to each carrier. We have a standard way we like to do it. There's not really a lot of guidance on that. You don't actually report to the IRS. What you do is very much like a lot of the other things that you do on your tax code. You're going to save that data and that information. The reporting actually goes on internally. It goes on internally within the company so that you, all the time, so that you understand how many drivers you're paying in excess. The IRS, if they showed up for an audit, would want to note that you were doing that. You would want to be able to prove that you were internally using a reporting mechanism, and that would if it's good, it would suffice. So it's not like you're reporting directly to the IRS. It's more of a report that you generate for your company that you would provide to an auditor if they came to audit.
Okay. I think right now those are the initial questions we had. Again, with any other questions or very specific questions, feel free to reach out to us, and please do. We'd love to let you know what we know about per diem. We know this area well. With there not being any other immediate questions as coming up on the chat that I see, I think we're gonna finish up here. And again, if you have any questions. Oh, I have one more question that just came in, Tommy.
Okay.
Can we pay based on averages? As in, if we pay drivers 5 days on per diem each week, they are not necessarily out 5 days in a given week, but average more than 5. Is that okay?
You can pay drivers based on average if you use a mileage rate, because that is how you have to do it. That's pretty standard. Obviously, if you pay a mileage rate cents per mile, you have a driver that's out 3 days one week, 5 days the next. Well, if he drives 1,000 miles both weeks, he's going to receive the same per diem amount. You have to be able to set your rates accordingly, your reporting accordingly, do all the things we talked about today and ensure that driver overall will still satisfy the plan. So I guess the answer is yes, if you pay a mileage rate.
Okay. Let's see.
Send a copy of it.
Yeah. So those of you who are wondering, we'll send a slide deck out to you as well following this presentation for those of you who are joining us. Let's see.
I want to answer this question, Dave, that I see. What is the average per mile per diem you see for over-the-road carriers? I want to answer this because there is none. Each per diem that we set up for carriers needs to be based upon that carrier's routes, that carrier's mileage, what they are doing as a carrier. So there is no standard. There is nothing that we see in the industry. Each carrier is different, and groups within each carrier can be even different. So it's not a question that we can answer even, because if you're setting up the rates properly, it doesn't matter what the next guy is paying. It matters what your drivers are doing and how you can comply with the IRS standards.
Yep. Okay, guys. There's a couple questions out there, but if you could, they look like they're getting a little specific to unique situations. If you could, just please email those over to Tommy or give us a call, and we'd be happy to address those. We just want to make sure that, again, some of these situations are very unique when it comes to your specific rates and everything, that it's tough for us to delve too deep into. But with that, please feel free to contact us with those additional questions, and we'll get to you. Again, we'll send a copy of the slide deck out to everyone who's joined us today. And again, we appreciate your time and for joining us today, and we look forward to hearing from you guys. Thank you so much.